morning, everybody. This is Patrick MontesDeOca with a live trading talk here for June 16th, 2022. Let's just take a look at the screen here for a minute. And we have a lot of red on the screen today. It looks like the gains, some of the gains that were made in stocks, ETFs, other derivatives are given back their gains here. But we continue to see a follow through in gold and silver. Gold trading last at $1829.50, up about $9.70, $10. Silver trading last at $21.52, up about 10 cents. So we have a kind of a mixed picture here, and it's just an indication of the condition of the market here with regards to interest rates. The Fed's increased interest rates yesterday by 75 basis points. And it's the biggest rate hike in 30 years. And as we take a look at the fundamental picture here with regards to interest rates and the Fed, it seems that, again, the Fed is behind the yield curve. It's behind the curve. And it's trying to catch up to this accelerated level of inflation that we haven't seen since 1981. The recent inflation gauge that we had came in at about 8.6%, which was much higher than expected. And it changed the narrative of the Fed to raise 50 basis points in the next two meetings. And instead, obviously, they made the biggest raise in interest rates in the last 28 to 30 years. Since 1994. The largest increase since 1994. The Federal Reserve took its most aggressive step yet to try to tame rapid and persistent inflation, raising interest rates by 0.75 percentage point on Wednesday and signaling that it is prepared to inflict economic pain to get prices under control. The rate increase was the central bank's biggest since 1994 and could be followed by a similarly sized next month, suggested Jerome H. Powell, the Fed chair, underscoring just how much America unexpectedly stubborn price gains are unsettling Fed's officials. And this is pretty much, I think, the Fed's chasing their tail on this issue here with interest rates. They're behind the curve. And, this is the fundamental picture that's causing basically a lot of confusion in the market back and forth. And we've seen that in the stock market trying to make a bottom. And most assets here seem to be coming down in anticipation of this increase. Now, what does that mean that the Fed's raised interest rates by, 3/4 of a point? Well, the cost of money is going up. Everything from loans, personal loans, credit cards, bank loans, anything has gone up in price in terms of the cost of financing it quite a bit. And this is the issue that I am dealing with right now, is that, number one, the Feds are behind interest rates. That essentially is indicating the effect that inflation is having here. They underestimated inflation, claiming that inflation was going to be transitory here for the last couple of years. And, we've had many surprises here. The war between Russia and Ukraine, one of them exacerbating the supply chain once again with regards to commodities, with regards to metals from the region, particularly grain. The area produces over 30% to the world, to the free world, particularly the Arab nations. And we are experiencing supply problems here that's building up potentially a very volatile summer, as the oil harvest is basically consumed, and the market now is looking for new planning, the future planning of grains, which I believe is going to be very difficult based on the current conditions in Ukraine, and essentially the continuation of this war, which is affecting the economies on a global scale. I think it's pretty obvious to me, and it should be, if you read between what's going on here with regards to Russia's attack to the Ukraine, it was a strategic attack that essentially is trying to control the commodities, energy, the deposits in the area of the Black Sea, the Ozab zone, the Ozab Sea, which are the second largest in the world. And it's pretty obvious that Russia is trying to become, by force, basically the largest supplier of energy and crude oil to the world. Force majeure, so to speak, by invading the areas that are essential to the transportation of energy to the NATO nations, to Germany, to the Eurozone. So it's going to continue to, I believe, create a lot of problems, in making supplies available here, and as we move into the summertime, and again, the demand for the new season comes into place here, we're going to see a lot of volatility in the market, and I think it's just a question of time. The weather recently is showing a lot of heat in the growing areas here in the United States, and so it's putting in a lot of pressure here in terms of, again, the supply and demand balance that we have in the grain area, as well as in the energy markets here. The crude oil market has traded as high as, once again, 116, challenging the previous highs that we saw at 120. And so we're going to continue to see disruption of supply from the area, and it's just a question of how this is going to affect, once again, the U.S. economy, the free economy, the Western economy, and the Eurozone economy, basically. We're running into high levels of inflation that are historic by nature, and as a consequence of that, the Fed action is also historic. So how do we take advantage of this crazy picture fundamentally. Well, I think you have to, at least for myself here, take a look at the underlying asset here that we have, which is the U.S. dollar, that is at an all-time high here. And if we take a look at the dollar index, it's been supported by the fear, you might say, of running to an asset that is the strongest, basically, supposedly the U.S. dollar as the world's reserve currency. When the Hispanics set in the financial markets here, geopolitical or otherwise here, you pretty much have the U.S. dollar as a safe haven to protect yourself against a disruption in the world financial markets and the currency markets. But the U.S. dollar is at a historic high here, and it's not fundamentally supported by the economics, you might say, that indicate that this should be the strongest currency. We're running a 30, or I would say close to 30 trillion, if not more, of U.S. debt, and the global debt alone is at levels that is pretty much unsustainable. And with interest rates going up here, the tail end of the debt, the tail end curve of the debt regarding interest rates is going to go exponentially. It's going to explode exponentially. The cost of money as we raise interest rates is going to have a major effect, not only in individuals, institutions, businesses, but also governments, particularly when we're running this incredible debt globally. And so, being in, from the old school, so to speak, in times of economic chaos, economic crisis, particularly when it comes to currencies, the purchasing power of currencies, inflation, devaluing currencies, we go back to gold and silver for thousands of years. And you can see the sentiment, the speculative sentiment that went into digital currencies, the money that was essentially free money, I believe, that was used, in a, I would say, inappropriate way by leveraging in Bitcoin, or by leveraging in some of these stock markets that obviously popped this stock market bubble. I think the big question, that I'm looking at as a trader here is, okay, how do I fit into all this once I take a look at these fundamentals, and I go back to gold and silver, basically, because as we begin to see the effect of prices, energy, crude oil going back up, potentially above 120, and it could be 200. I hear some comments out there for $300 crude oil. So, if this war continues in between Russia and Ukraine here, it's possible that we could see the energy markets here go to $300 a barrel crude oil, and that would be very beneficial, obviously, for Russia. Tremendous revenue to support and finance the war. It just seems that this was a plan, a predetermined plan. The cause and effect of the plan economically becomes an economic war against the Western world. And this is what we're dealing with right now here. It's not just a physical war against Ukraine here, but it's an economic war. And, Russia is pulling the muscle by being the second largest producer, crude oil producer, energy producer to the world. In a very obviously, I believe, aggressive way. in a totalitarian way, which is not friendly for Western allies or NATO nations, you might say. So we have a political conflict, a geopolitical conflict. We have an economic conflict here. Inflation is running during a supply chain disruption, during basically the worst level of inflation in 41 years, and the world record debt, obviously, historically, that we have. So it is a delicate, I believe, measure in terms of how you manage interest rates, because the fact that we are seeing prices at these levels here, it's just a question of time before record level prices here begin to destroy demand, consumption. Because what will happen here is that people will find alternatives. They'll stop buying certain products. They'll drive less. They'll use alternative ways of driving, and pretty soon you have demand destruction. And that's not very good for anybody, basically, because then potentially what we're going to see here is an economic slowdown that, depending upon how fast things turn around here, also it's going to make the Feds make a U-turn with regards to interest rates. And so we got to pay attention here to basically what the market is doing, what the market has done. And as you can see, in taking a look at the 10-year note, the market is leading the way with interest rates, not the Feds. We have the 10-year note trading at 341. And this is not the Feds raising rates. This is the market moving rates from the low that we saw back in 2020 of about 0.033% to where we are right now at 340, 341. I think what most people are not aware of, or not talking about it enough, is the fact that the market itself, realizing the economic fundamental picture of the US dollar, particularly as we came into this pandemic in 2020, it realized that rates cannot continue to be near negative, or if you really factor in inflation, at a negative yield. And so what we've seen is within 2 years, interest rates rise from 0.33% to 3.45%. And we haven't yet seen the consequences of this shift in interest rates that caught everybody by surprise. And for most people that essentially did not lock in fixed rates at those levels here are in deep trouble here, with rates moving up this fast, this high, when essentially for the last 2 years people have been leveraging up to the gilt with free money provided by Uncle Sam. And this is the underlying factor, I believe, responsible for this huge demand that, when you think about it, went into for example, high leveraged virtual currencies, and you're looking at trillions of dollars that have been transferred of that money to, people that went short. There was an exchange of wealth that took place here at the same time in the shortest amount of time. Between all the digital currencies and Bitcoin, you're looking at trillions of dollars that have been transferred to stronger hands. For every loser, there is a winner. And so all these buyers here, all these gurus on the internet, all these experts, you don't hear them anymore. The B plan, the C plan, all the Bitcoin experts, these are kids, millennials, that did not have any understanding at all about using leverage and did not have the understanding of inflation, because this is the first time that the United States is faced with inflation, with the real effects of inflation, the impact of what it is to see prices double in the last 2 years. And I think that the whole Main Street economy is in shock. I am certainly, when I take a look at this and I talk about this and I write about this, it's an incredible reversal in interest rates by the market dictating where they should be according to the economic fundamentals that we're dealing on a global basis. And so what the central banks are doing right now is simply trying to catch up to what the market is doing. They're like a dog chasing its tail. So in times like this, once again, I think for my traders here, I want to continue to recommend to hold on to your derivatives, metals derivatives. There are no trades today. The market is trading above standard deviation in a bullish manner daily, and it's within a daily and weekly pattern of accumulation or an area of support. So we're looking for prices to get above 1841 again and activate a weekly trigger, which will essentially confirm strongly that the daily mean here trading above 1830 is very bullish. And then the targets that we're looking at is 1852 to 1860 for the rest of the week. Let's take a look at silver here. Silver as well is trading between the weekly and the daily standard deviation, so there are no signals, but it is with a bullish daily price momentum, and the levels above the targets here, 2191 to 2203. The NASDAQ is in a bit of a correction once again here, making a low of 11,203 as of today, coming back down into the weekly B2 level of 11,202. Okay, that we've had for this whole week, and this is where we're beginning to see potentially a reversion unfolding here, once again activating a weekly buy trigger, and right below there we have a daily buy 2 level there of 11,157. So be on the lookout for a reversal to the upside here on the stock market, on NASDAQ in particular. And close above 12,202 obviously already has activated a buy trigger. The low is 11,203, and the code was indicating 12,002 as a buy, so that's pretty close. So continue to hold your upward buys and look out for a reversal from here, from this area to the upside. And Bitcoin, we're looking at as well the market entering an area of support, or has built support around 20,000 and building a base here, and is in an area of accumulation as well. So it looks like for most of the markets here today, they're in a kind of a neutral to bullish zone, and we want to get a little more clarity before we do any trading here for the day. But in the meantime here, it looks like things are turning bullish. Looking at the gold market, it's activating a daily buy, a daily bullish price momentum, and you see the targets are 1841 to 1852 for the rest of the day, for the rest of the week. For the time being, my friends, I want to wish you a good trading day here today. Just to recap, just keep your composure, stay long, and buy corrections in metals and in the NASDAQ as well here, looking for upside reversals. Have a great day, my friends here, and I'll talk to you next time. You be well.